Okay, so hello and welcome to my Microeconomics lecture series. So in this lecture, I'm talking about international trade. So talk about international trade, I'll talk about imports, exports, tariffs, and deadweight loss, and we'll illustrate these graphically. All right, so the first consideration, without international trade, the market for whatever is the good we're studying includes only domestic demand and domestic supply. The market equilibrium is going to be at whatever price and quantity clears that market, right? So we don't expect any shortage. We don't expect any surplus. We expect an equilibrium. Prices should adjust to equilibrium. So that would be this picture. Without international trade, we have our domestic demand curve. We have our domestic supply curve. We have consumer surplus. We have producer surplus. We have an equilibrium quantity, which is restricted to how much this economy can produce for themselves. All right. So this is without trade. Oops. So before opening up to free trade, the domestic market is in equilibrium at whatever is that market price. And very likely, whatever is that domestic price is either above or below the world, or above and below the world price. So when I say here, the world price is actually probably above or below whatever is the domestic price. What's the world price? Well, the world price is the prevailing price of the good in the rest of the world, in the world market. After free trade, we open up the borders to trade. We allow trade to occur. What's going to be the price? Well, the price is going to be the world price. So there's initially a disequilibrium where the world price is different from the domestic price. And when the economy's opened up, it's the world price that governs whether a particular country is an importer or exporter. The economy is going to respond and satisfy this disequilibrium by either importing or exporting until the price that trades are happening in the domestic economy matches the price for the rest of the world. So what's the domestic price doing? We have an interesting interpretation. Remember opportunity costs. So opportunity costs measure what's sacrificed, what's given up when you do one thing instead of another. So it's the value of the next best alternative use of a resource. Well, the domestic price is capturing the opportunity cost of the good. So think back to production possibilities, frontier, and comparative advantage. The domestic price shows essentially how much that country is giving up to obtain one more unit of the good. If the domestic price is low, the cost of producing that good in that economy is low. The country has a comparative advantage. If the domestic price is high, the cost of producing that good is high. Country would lack a comparative advantage relative to foreign countries. Well, if you have a low price, if you have a comparative advantage, you ought to export. If you have a high price, you lack a comparative advantage, you ought to import. That's exactly what I say here. If the world price is higher than the domestic price, there's a surplus in the market at the world price, right? So if the domestic price is lower, we know that country has a comparative advantage in that good. That country should therefore export. It should export that product, and this will be to the benefit of local firms. This allows domestic producers to find buyers. Right? There's a surplus domestically. The firms have run out of buyers. We can find more buyers if we go abroad. So we can find some foreign buyers for their surplus production. Cool, so exports. And this is the picture. So let me unpack what we have here. Here's the price. Here's our quantity. Okay. Let's think about the price before trade. Before trade, the economy is limited to where the domestic supply meets the domestic demand. So without international trade, the equilibrium quantity would be right about here. Right? So the consumer surplus before trade would be area A and area B, which includes this little triangle here. Producer surplus before trade would be just area C, which I mean to include this little triangle here as well. Now, suppose we open up our borders to trade. We have a comparative advantage. We have a lower domestic price than the world price, so it's good to trade. So the price with the trade, once we open up to free trade, is higher. This is good for domestic producers. Look, domestic producers gain area B. And this is where's this area B coming from? They gain area B from their own economy, right? This means domestic consumers are paying more. They're not happy about that because now Right. So there's one price in the economy. The price is no longer the domestic price. It's now the world price, because domestic consumers are competing with foreign consumers. That's what Area D is coming from. Area D is corresponding to producer surplus that's gained by virtue of exporting. This is the domestic demand. This is the quantity demanded domestically at the world price. It's smaller than what it was at the domestic price. When we open up our borders to free trade and become an exporter, it hurts domestic consumers. They buy less, they pay more for what they're buying. But it helps domestic firms. There's exports. Here's the domestic quantity supplied. Here's the domestic quantity demanded. Hey, if quantity supplied is bigger than quantity demanded, we have a surplus. Where's that surplus going? It's going abroad. So Area D is being sold at the world price to foreign consumers. So after trade, consumer surplus falls. Domestic consumers pay more and get less. That's bad. After trade, producer surplus rises. Producers sell more at a higher price. That's good. With trade, there are winners and losers. Economists typically argue that winners win more than the losers lose. But those wins and losses might be highly concentrated in some cases. And so there's some nuance there. Anyway, so total surplus has risen. Total surplus has risen with trade. Trade makes everyone better off. Okay. All right. Without trade, consumer surplus is the area above the domestic price, below the domestic demand curve. We know what consumer surplus is. We saw area AB. With trade, consumer surplus falls to the smaller triangle above the world price. That's because domestic consumers are paying more and getting less. Producer surplus without trade is the area below the domestic price and above the domestic supply, area C. And with trade, producer surplus is the entire area below the world price. Area C that they're getting, that they're selling domestically, and area B and D that correspond to, area B that they're now getting. So area C is initially what domestic producers were selling domestically. That was their surplus, their local profits. Now we're getting additional profits B that we're pulling off of our consumers locally, and we're getting area D from abroad. Okay. In this situation, free trade makes domestic producers better off at the expense of domestic consumers, in some sense. Domestic consumers are worse off. Producer surplus grows by more than consumer surplus shrinks, so economists argue, hey, we ought to do this. We ought to export. The winners are winning more than the losers are losing. Total surplus goes from A plus B plus C to A plus B plus C plus D. Right? There's gains from trade. Those gains are area D. All right. What about the importer? Does the importer get a bad deal here? No. Well, let's find this out. So if the world price is lower than the domestic price, there's a shortage at the world price. If the domestic price is higher, we know the rest of the world has a comparative advantage. What do we learn from the production possibilities frontier model? Well, we learn that traders should specialize according to comparative advantage, and you ought to get the good from the trader with the lower comparative advantage. That's going to make everybody better off. This country should be an importer of whatever product that this is, where they have the higher domestic, where they have a domestic price that's higher than the world price. By importing, the country is able to find foreign producers willing to sell to domestic consumers. We're now able to meet our domestic demand through trade. All right, so here's the picture. Here's our domestic demand curve. Here's our domestic supply curve. Without trade, the equilibrium quantity is right here. And the equilibrium price would be the domestic price. But look, the world price is lower, indicating the rest of the world has a comparative advantage. Well, this country ought to import. Here's consumer surplus before trade, area A. Here's producer surplus before trade, area C and B. Well, if we open our borders to allow imports, now trade happens at this price. At this price, more consumers are able to be served, right? Area D is going to be, so what's the new consumer surplus? With trade, consumer surplus, after trade, it's area A plus B plus D. Okay, so area A was the existing consumer surplus. We now add area B. At the lower price, we're going to get part of area B, not all of it, but we're going to get part of area B from domestic producers. This means that domestic consumers are, wherever this line is, this is the quantity that's supplied domestically, right? So I should have actually drawn a vertical line right here to correspond to these units. Basically, domestic consumers are getting a better deal for this quantity right here locally. They're actually getting more from domestic producers. Domestic consumer surplus or producer surplus falls to area C because part of area B is going to the domestic consumers instead. What's going on is the rest of the world is outcompeting our domestic producers. That might sound bad at first, but what's happening is we're able to import. Area D is new consumer surplus. Actually, this part of the triangle as well. Area D is new consumer surplus that's actually happening by virtue of importing these units from abroad, right? So consumers are now benefiting by getting Area D. Consumers are finding foreign producers who are willing to sell to them at this low price. This is really good for domestic consumers. Yeah, it's really bad for domestic producers, but economists argue that the winners are going to win more than the losers lose. We see this here. Winners win more than losers lose. Total surplus before trade was ABC. Total surplus after trade was A plus B plus C plus D, right? Total surplus has risen. What do we notice here? Look, for every exporter, there's an importer. For every importer, there's an exporter. What do we see in both pictures? These things are complementary. We could for every importer, there's an exporter. For every exporter, there's an importer. In both of these pictures, total surplus rises with trade. There's gains from trade. Trade is good, right? Efficiency has risen. On average, everyone's better off with trade. Without trade, consumer surplus is the area above the domestic price below the domestic demand curve. That was area A. With trade, consumer surplus increases to the larger triangle above the world price. A plus B plus D. Producer surplus without trade is the area below the domestic price and above the domestic supply curve, B plus C. And with trade, producer surplus is a smaller area below the world price, area C. What's going on? Well, with trade, consumers are pulling off some surplus, part of area B. It's not exactly area B, but part of area B from domestic producers. And they're getting a large part, they're getting imports. They're getting benefit from foreign producers, right? So what's going on? Free trade is going to make domestic producers worse off, but domestic consumers better off. Do you like imports? Well, are you a producer or are you a consumer? If you're a consumer, you like imports. But consumer surplus grows by more than producer surplus shrinks. So total surplus rises from A plus B plus C to A plus B plus C plus D. There's gains from trade, right? These gains are area D. All right, well, so suppose our domestic producers don't like this. Suppose our domestic producers don't like this. They're losing out. They're getting lower profits because the price has fallen, and some of them have costs that are too high to participate in the market. So they lobby the government and ask for a tariff. What happens? Okay, so we can think of the effect of tariffs. Tariffs are a tax on imports. Produced abroad, goods produced abroad and sold domestically. Right? So important thing to keep in mind, don't make a mistake here. When we're analyzing the effect of a tariff, the tariff is a tax on imports. It's not a tax on all units consumed. It's just a tax on the imported goods. The idea here, the goal from the perspective of domestic firms, is to level the playing field and to take away the comparative advantage from foreigners. So under free trade, the domestic price converges to the world price. In the case of imports, this would force domestic suppliers, relatively less efficient, to compete with international producers with a comparative advantage. What the tariff does is raises the price of imports in order to assist domestic producers by preventing them from being as severely undercut. That's the idea of a tariff. Okay. The point of tariffs is to move the market price closer to the no trade equilibrium price, which is good for domestic producers, but this comes at the expense of domestic consumers. And it comes at the expense of efficiency. So it reduces the gains from trade. Domestic producers are better off. Government raises revenue. But the losses to domestic consumers are larger. There's inefficiency introduced. We're going to see our old friend, Deadweight Loss, or our old nemesis, Deadweight Loss. All right, so here's the picture. So without the tariff, so a couple things going on. So first, without any sort of trade, the domestic equilibrium is right here. The domestic equilibrium quantity is right here. Domestic equilibrium price is way up here. With free trade, that occurs at the world price. At the world price, the quantity traded is way out here. Way out here. At the world price, consumer surplus grows from area A to area B, C, D, E, F. So with trade without a tariff. So before the tariff, consumer surplus is huge. It's area A up to F. Before the tariff, producer surplus is small. It's area G. Right? After the tariff, what happens? We're going to add we're going to add a tax on imports. This is going to raise the price that foreign producers are able to sell their good at, up to a level that more domestic producers can compete with. So now this is going to be the market price. What's going on here? Well, remember the supply curve. Domestic supply is giving us the costs of domestic sellers. So what's happening right here is at the world price, without the tariff, these are the only domestic sellers with costs low enough to compete. These domestic sellers have costs that are too high. If we add a tariff and force foreigners to compete at a higher price, now these domestic producers are able to join the market. So that's good for them. All right. Let's think about what happens to surplus. Well, if we, relative to the trade to free trade at the world price, when we add the tariff, consumer surplus shrinks. Consumers lose C, D, E, and F. Consumer surplus is now only A and B. Right? The actual market traded, the quantity domestic quantity demanded is right here. The domestic quantity supplied is right here. Domestic quantity supplied, this is saying how much are local producers willing and able to produce and trade at this price. So this is the amount, this is the quantity supplied domestically. This is the quantity that we're getting from domestic producers. That's not how much is actually traded, because we're importing, right? The imports with the tariff brings us out to here to meet our domestic quantity demanded at the tariff price. Okay? Well, domestic producer surplus rises. Now it's area C plus G. So domestic producer surplus is now area C plus G. Government revenue, where's tariff revenue? Well, remember the tariff is a tax on imports. So we got to find the imports. The imports are to make up the shortage between the domestic quantity demanded and the domestic quantity supplied. So the tariff, the tax on imports, is only area E. What's area D and F? D and F are deadweight loss. Okay? D and F are deadweight loss. F is a familiar deadweight loss. F is a familiar deadweight loss in the sense that here is a situation where we have consumers who value goods more highly than they cost to produce, but trade that does not occur. Right? The demand curve lies above the world supply curve, the world price, meaning these consumers value these units more highly than they cost to produce, but those trades don't happen. That's our traditional deadweight loss. What's this? This is a different type of inefficiency. What's happened here? Look, here is where we have domestic producers with a higher cost curve than foreign producers. The domestic supply curve right here lies above the foreign supply curve, which is represented by the world price. What's this telling us is that here we have production that's been allocated to inefficient producers, inefficient domestic producers, right? Think back to the previous lecture. I think this is a lecture on price controls. I begin by talking about inefficiency and efficiency. And we said that inefficiency enters two ways. One, by having consumption go to consumers that are not that do not value the goods most highly. And the other way that we can introduce inefficiency is if production is not allocated to the most efficient producers. That's the problem with a tariff. We are favoring inefficient domestic producers over more efficient foreign producers. So this is good for the domestic producers, bad for domestic consumers, and bad for overall market efficiency. So there's gains to trade. Trade with the tariff is better than no trade, right? We see that clearly. Here's no trade. There's no trade quantity right here. Here's the no trade price way up here. Trade with the tariff is better than that. There's a larger quantity, more consumers are served at a lower price. So trade with the tariff is better than no trade, but trade with the tariff is not as good as free trade. So, all right, the tariff reduces consumer surplus by the areas indicated, C, D, E, and F. Producer surplus area increases by area C. So C is transferred from consumers to producers. What about area D, E, and F? Well, E is the rectangle with sides corresponding to the size of the tariff and the units of output to which the tariff is applied, because the tariff is only paid on imports. Remember, tariff is a tax on imports, and this is revenue to the government. Area D and F, this is deadweight loss. This is units that are no longer traded in the case of F, and these are units inefficiently produced in the case of D as a result of the tariff. F, like I say, relatively familiar inefficiency introduced into the market. Consumers willing to pay more for the output than it costs to produce, as measured by the fact that the demand curve lies above the supply curve. But these trades aren't taking place. Area D is a form of inefficiency, haven't yet been introduced to, at least graphically. I introduced this before. This corresponds to the production that was formerly accomplished by relatively more efficient foreign producers, but as a result of the tariff are now produced by relatively less efficient domestic firms. So we know this to be true because the cost curve, as modeled by the supply curve for domestic firms, is higher than the cost curve for foreign firms, as measured by the world price for those units. So clearly inefficiency. Is this good? Do we want this tariff? I don't know. I mean, so it's a sort of an empirical question, and it's one for debate. There's a lot of nuance here, right? But clear, the effect on market efficiency is clear. Okay, so there's winners and losers with every policy. Domestic producers do better with the tariff. Domestic consumers are worse off. So what ends up happening? The tariff raises the price for international firms. It reduces the quantity of imports, and it moves the domestic market price closer to the no trade equilibrium. So that's just the pure effect of the tariff. Okay, so there's another protectionist strategy governments can use, and that's quotas. Quotas are limits, quantity limits on imports that work a little bit different than a tariff. So tariff is a tax. It's a price control, not a price control, but it's a price intervention. Quotas are a quantity intervention. So the idea is that with quotas, the government doesn't tax imports, but it limits the amount that foreign firms are able to sell. So in some sense, this affects the price, right? Smaller quantity, higher price. By the law of demand, we expect low quantities to correspond to higher prices. With the difference with the tariff is that these higher prices are market determined, right? Market determined, not determined with a tariff. More market determined. Okay, the other interesting thing, the quota. So think about how firms are going to respond. All right, so the foreign government tells you can only bring in a certain amount. You can only bring in 100 units of your product or 1,000 units of your product. What are you going to do? Well, I mean, maybe you're going to bring in the 1,000 high quality units of your the highest quality units, your 1,000 best units, and sell them at the highest price, right? This is a quantity limit, not a price limit. So let's sell my best 1,000 units. If the quota is 1,000, let me sell my 1,000 best units at the highest price possible, and then be able to extract as much profits from this market. And think about what foreign automakers do in response to quotas. It's actually not too far from the phenomena I just described. So anyway, very interesting.